We are still talking about intermediate accounting. I'm using Kieso book and I'm gonna talk about chapter 14, bonds payable, when issuance at par. So we have this question from Kieso book. Santos SA issues $100,000 in bonds dated January 1st, 2022, due in 5 years, with 9% interest payable annually on January 1st. Okay, so what does that mean? He issued 100,000 in bonds. This is the face value. It's called face value, okay? Okay, dated January 1st, 2022. So it's gonna start on January 1st, 2022. Due in 5 years, يعني I need to pay them back after 5 years. This is maturity date, okay? يعني after 5 years from now, okay? Now, he said 9% interest payable annually on January 1st. So this is called the stated rate, And the interest will be payable annually on January 1st. So we started on January 1, 2022. It's due in 5 years, so N it's 5, okay? At the time of issue, the market rate for such bonds is 9%. So again, the market rate, it's 9%, okay? So the 100,000, it's the principal. It's gonna be paid at the end of the 5th year. يعني بعد 5 سنين, I'm gonna pay 100,000. But today, I'm gonna receive the present value, okay? I'm gonna receive the present value of two things. Of the interest payment that I'm gonna pay annually for 5 times, plus I'm gonna pay the 100,000 after 5 years. I'm gonna pay it only once. Okay, so now the stated rate is 9%. It equals the market rate, so it's issued at par, okay? When the stated equals the market, it means it's issued at par. يعني the present value will equal the face value. Now, and it's 5 because he said it's going to be due in 5 years. The face value, it's the principal, which is the 100,000. This is the amount I'm going to pay at the end of the 5th year, بعد 5 سنين. Present value, it's unknown, you can calculate it. But again, based on the given information, because the stated equals to the market, it will also be 100,000. Okay, but let's assume that it's unknown. Now the payment, the interest payment, the periodic interest payment that I have to pay annually 5 times on January 1st, as he said, it will be calculated by multiplying the face value, which is the principal, the 100,000, by the stated rate, which is 9%. So it's gonna be 9,000. So I'm gonna pay two things. I'm gonna pay as a bond issuer, not holder. So I'm the seller, I'm the one who issued the bonds. Today I'm gonna receive the present value, which is the selling price of the bonds. I'm gonna receive 100,000, which is the face value after 5 years. I'm gonna receive it only once, while the payment I'm gonna receive it annually 5 times. So I'm gonna receive it on January 1st 5 times, 9,000. So present value, I need to find the value for the 100,000 that I will pay after years. I need to find the value for it now, and I need to find the present value for the payment, which is the 9,000, but I'm gonna pay it 5 times. So I'm gonna use annuity table for this one, okay? Because it's gonna happen more than once. I'm gonna pay the 9,000 5 times, not only once, okay? So let's see how to calculate it. So present value, okay? First, I need to calculate the present value for the face value, which is the 100,000. So I'm gonna go to the table, which is 6.2, which is called present value for single sum. يعني when the amount will be paid only once in the future, we go to the present value of single sum. بيكون عليه مكتوب only $1. Okay? لأنه ليه؟ لأنه I'm gonna pay it only once in the future. Single sum مرة واحدة. So I'll go to n equals to 5, I equals to the market rate. Again, n it's 5 because the number of period it's 5, okay? And I will be the market rate, which is 9%. So we're gonna go to the table, to the present value single sum table. I'm gonna go to n 5, I 9%, which is the market rate, and I will get the factor, which is 0.64993, and we're gonna multiply it with 100,000, so we're gonna get 64,993. Okay, so this is the first part. Okay, again, you need to calculate the present value for all the cash outflows. This is one of them. I'm gonna pay the principal, which is the 100,000, only once after 5 years. So I'm gonna go to the present value single sum table. And again, you're gonna pay the periodic interest payments, which is not the 9,000 that we just calculated. We said it's face value multiplied by the stated rate. So 100,000 multiplied by 9%, it's gonna be 9,000. So again, we said the 9,000 will be paid 5 times, because he said annually, سنويا, for 5 years. So I'm gonna pay it 5 times. So since it's gonna happen more than once, I'm not gonna use present value single sum table. I'm gonna go to the present value annuity table. Okay, annuity table, because the 9,000 will be paid 5 times, not only once like the principal. So we're gonna go to the present value annuity table at N5, I 9%, which is the market rate. Okay, and I'm gonna get the factor, which is 3.88965, and I'm gonna multiply it with the payment, which is the 9,000. We're gonna get 35,007. So total present value of the selling price that I'm gonna receive today, it's equal to the sum. I'll add 64 to the 35, so it's gonna be 100,000. As we said from the beginning, if the stated rate is equal to the market rate, it means the present value will equal the face value, because it means it's issued at par. So this is the proof. As you can see, the present value, it's 100,000. Okay, now let's prepare the journal entries. When issued at par, no need to prepare amortization table. Okay, you're gonna know about the amortization table later on when I explain the issuance at premium and issuance at discount. But for now, when it's issued at par, the present value, it equals the face value, so there is no difference to be amortized over the years. Okay, ما في فرق بين the present value and face value, so no need for the amortization table. Okay, so first, on January 1st, 2022, issue bonds. We issued the bonds. I sold them. So what's gonna happen? I'm gonna receive cash. So cash, it's an asset. It will go up in the debit side. What's gonna happen? I'm gonna create a liability. Okay, I'm gonna pay them later. Bonds payable. It's a long-term liability. As we said, it's non-current liability. So bonds payable, it's a liability. It will go up in the credit side. As you know, assets equals liabilities plus equity. Assets increase in the debit side, while liabilities increase in the credit side. Okay, so this is when we issue the bonds. Now, at the end of the year, as you know, we need to adjust our records. Okay, so I need to record the accrued interest expense, because I'm gonna pay it on January 1st, as he said in the question. So at December 31st, it's incurred, but it's not paid yet. So incurred معناته I need to record an expense on the debit side. Since I'm gonna pay the interest, I'm not gonna receive it, so it's an expense to me. So it's gonna be interest expense on the debit side. In the credit side, I did not pay it yet. It's not cash. I'm gonna pay it tomorrow. He said I'm gonna pay it on January 1st. So it's gonna be interest payable. It's a liability. Again, expense on the debit side, because expenses decrease equity. It will always be in the debit side. Interest payable, because I did not pay them yet. I'm gonna pay it tomorrow. That's why it's accrued. Okay, So interest payable will increase in the credit side, and the amount will be the 9,000, the payment of interest. Okay, now the next day on January 1st, what's gonna happen? I'm gonna pay the interest, the 9,000. So I need to decrease the liability, which is interest payable. So interest payable will go down in the debit side. And again, you are paying, I'm gonna pay, so cash will decrease in the credit side. It's an asset. Assets decrease in the credit side. Hope it's clear. So we're gonna repeat this 5 times. December 31st and January 1st, these 2 entries related to the interest will be repeated 5 times. And at maturity date, يعني when I pay the principal, I'm gonna switch the first one. So it's gonna be bonds payable to cash, because I'm gonna pay the 100,000 after 5 years. Okay, hope it's clear. Thank you for watching. If you have any question, please leave a comment. Please like, share and subscribe.